Imagine two companies. Same market cap. Same revenue. Same profit. But one of them costs you 3 times more to actually own. Sound impossible? It happens every single day on Wall Street. And 90% of retail investors never even see it. For 50 years, I've watched investors make the same expensive mistake. They look at a stock's market cap and think that's the price tag. It isn't. Not even close. Today I'm going to show you the number Buffett actually uses when he buys a business. The same number every private equity firm calculates before writing a check. It's called enterprise value. And once you see it, you'll never look at a stock the same way again. Here's the problem with market cap. It only tells you what the equity costs, not what the business costs. Think about it this way. If I told you a house was selling for $500,000, but it came with a $400,000 mortgage, you had to assume, is that really a $500,000 house? Of course not. You're paying $900,000. The market cap is the equity check. Enterprise value is the full price. The formula is beautifully simple. Take market cap. Add total debt. Subtract cash on the balance sheet. That's enterprise value. Why subtract cash? Because the moment you buy the company, that cash is yours. It effectively reduces what you paid. And here's where it gets really interesting. Two companies can have the exact same market cap and be priced completely differently in the real world. Let me show you what this looks like with real numbers. Look at Verizon and look at AT&T over the past few years. As of early 2025, Verizon's market cap was around $170 billion. Sounds reasonable for a telecom giant. But Verizon also carries about $150 billion in long-term debt. Their cash position, roughly $4 billion. So the enterprise value? Around $316 billion. Nearly double the market cap. Now compare that to a company like Adobe. Around the same time, Adobe's market cap sat near $220 billion. Their debt? About $6 billion. Cash and short-term investments? Roughly $8 billion. So Adobe's enterprise value was actually less than its market cap. Around $218 billion. Two companies. Both massive. But the real cost to acquire them tells a completely different story than what the headlines show. One is a debt-heavy giant. The other is a cash-rich machine. Market cap alone can't tell you which is which. In 2009, Warren Buffett made what he called an all-in wager on the economic future of the United States. He bought BNSF Railway. The headlines all said $26.3 billion. That was the equity check Berkshire wrote. But Buffett didn't just pay that. He also assumed roughly $10 billion in BNSF's existing debt. The true enterprise value of that deal, around $44 billion. Buffett never gets confused between the two. He's said it many times in his shareholder letters. When he evaluates a business, he thinks like a private buyer. A private buyer doesn't just pay for the equity. They take on everything. Debts. Pensions. Liabilities. The full cost. And in return, they get the cash on the balance sheet. That's enterprise value thinking. That's how the pros operate. And here's the part most retail investors miss completely. The valuation ratios you read on stock screeners, like price to earnings, they use market cap. But the smart ratio? It's EV to EBITDA. Enterprise value divided by earnings before interest, taxes, depreciation, and amortization. It cuts through the capital structure. It tells you how expensive the actual business is. Not just the stock. I want to give you one more example. Because this is where it really gets dangerous. In 2007, before the financial crisis, plenty of home builders looked cheap on a price-to-earnings basis. Their market caps had fallen. Their stocks looked like bargains. But the smart investors looked deeper. Many of those home builders had loaded up on debt during the boom. Their enterprise values were 3, 4, sometimes 5 times their market caps. The equity might have been cheap, but the business was leveraged to the moon. When the housing market cracked, that debt didn't disappear. It crushed shareholders. The lesson? When debt is high and cash is low, market cap is an optical illusion. It makes companies look cheaper than they really are. And in a downturn, that illusion breaks brutally. Here's the principle I want you to walk away with today. Market cap tells you what the stock costs. Enterprise value tells you what the business costs. And every great investor I've ever studied thinks in enterprise value. Because they're not buying a ticker symbol. They're buying a piece of a real business, debts, cash, and all. Price is what you pay. Value is what you get. But before you can judge value, you have to know the real price. So here's my question for you. Pull up one stock you currently own. Look up its total debt. Look up its cash. Calculate the real enterprise value. Is it close to the market cap, or is the headline number hiding something? Drop your finding in the comments. I read every one. And if this changed how you look at a stock, hit subscribe. We do this every single day. Tomorrow, we're tackling the 1 ratio Buffett checks before any other. You don't want to miss it. This is educational content, not financial advice. Always do your own research.